Welcome to Good Money Moves, the show where we share financial tips and advice to help you feel financially empowered. I'm Jenna Taubel, AVP of Marketing here at First Alliance Credit Union, and today I have with me Nick Meeker, our real estate lending manager here at First Alliance. And if you can put two to two together, the reason I've got Nick here is because we're going to be talking real estate mortgages, specifically the different types of mortgages that are out there that you could be considering if you're starting your home buying journey. But before we dive into our topic today, Nick, welcome.
Thank you
for being here. Why don't you just share a little bit about yourself and what is a real estate lending manager? What do they do?
Yeah, I was born and raised in Rochester. I have been in the mortgage industry since 2012. And I've worked for some of the largest lenders in the United States. I worked for some of the smallest banks in town here, and now I'm with First Alliance Credit Union, and I'm happy to be here.
Awesome, and we're happy to have you.
Thank you.
Awesome. Well, let's just dive right into the topic today, because we could have a whole separate show about mortgages. I feel like, honestly, it's such a big topic, a big world, but today we're specifically talking about the different types of mortgage loans that are out there, because I feel like that's an area where a lot of people probably just think the conventional 30-year mortgage is just what you get, but there's actually a lot of other options out there. And so I want to make sure that people understand the options that are out there. So let's just maybe start at a high level. What are maybe the more common types of mortgage loans that people are going to hear about or take advantage of?
Yeah, so you got, like you mentioned, you got the 30-year fixed conventional loan, which can also be a 20-year fixed conventional loan, a 15-year, a 10-year fixed. There's different terms for each loan type. And then another common one that people have heard of is the FHA loan. Mm-hmm. A lot of people think that stands for first-time home buyer because of the FH in FHA, but it's actually stands for Federal Housing Administration. And so that's a really nice loan, because if you have damaged credit or if your debt to income ratio is high, that's a loan that we find ourselves putting people in a lot of times because it's more lenient than a conventional loan. It allows people to go down, at least with us, to a 640 credit score. Okay. Versus something like a conventional loan, you have to have cleaner credit. You'll have to have at least probably a 680 credit score. And then aside from those two loans, there's really two other main loans that are out there, which is the VA loan and the USDA loan. Okay. And so the VA loan is the Veterans Affairs loan. So if you've served in the military and you have a certificate of eligibility, you can use that to apply for a loan. And that's an awesome loan because it's 0% down, so you don't need a down payment. Oh. And then I should backtrack a little bit. The FHA loan, you need a 3.5% down payment. The conventional loan, you need a 3% down payment. So the VA loan is no down payment. And then the USDA loan is the United States Department of Agriculture. So that loan is for people that want to buy a house in St. Charles, Yoda, Elgin, Orinoco, basically anything outside of a large city. Sure. And that's also no money down, 0% financing.
So there's a lot of options, it sounds like, for home buyers who maybe aren't in that perfect situation, quote unquote, where you have the 20% down, you have the full, best credit score out there. It sounds like there's some programs for people. But how should someone maybe go about comparing these different programs? Is there specific, fees involved with any of these? How do they know which one to pick? Or is it even not up to them?
So as a lender, the lender that you're working with should be kind of going over the different loan types with you. When we pull somebody's credit score, that's ultimately going to narrow down the list of loans from, let's say, the 4 loans that we just discussed to maybe just there's only one option available. Sure. So credit scores play a big factor into things. Once we pull your credit report and we can see what's on there, we'll be able to see all your debts, your credit score, and those two things play the biggest factor into what you're going to be able to do. Outside of that, we look at down payment, and that's pretty much the other variable that plays into things. And so as long as you can meet whatever loan program's down payment requirement, then you would be able to qualify for that loan if you hit their credit score criteria and their debt to income ratio criteria.
Okay, so I'm just going to kind of recap what you said. So it sounds like credit score is a component to each of these, debt to income ratio, and the down payment that you have upfront are really the three big factors to think about as you're kind of choosing what mortgage product to move forward with.
Yes, exactly.
Okay.
100%.
Awesome. So I want to just back up a little bit and talk a little more about the FHA loan, because I feel like that's probably one that most people are familiar with. And to your point, a lot of people associate it with that first-time home buyer loan. Can you talk a little bit more about why that is such a good product for somebody who's a first-time home buyer?
Yeah. A lot of times that gets used and gets confused as a first-time home buyer loan. It's not even a first-time home buyer loan. You could use that loan if it was the 10th house that you've bought. But you can only use the FHA loan if it's going to be your primary residence. You can't use it if you're buying an investment property or second home or anything like that. But the nice thing with the FHA loan is because it's so lenient with credit scores, you know, if you have any credit blemishes, if you've had a bankruptcy in the past or foreclosure, if you have collections and your credit score's been dragged down because of things like that, the FHA loan is going to be a lot more lenient with allowing you to qualify for that loan versus if you try to get a conventional loan, it's going to be harder to qualify and the pricing is probably not going to be as good. So what happens is the interest rate that you're given as a consumer is based a lot of times on your credit score. And the FHA loan doesn't have all of the pricing adjusters based off of credit score that a conventional loan would. So conventional loans get really picky. They basically go in 20-point buckets where if your score is between 680 and 700, that's one bucket. If it's between 701 and 720, that's another bucket. And then 721 to 740 is so each bucket higher that you get a better interest rate. With the FHA loan, it's pretty straightforward. It's basically like if your credit score is 660, here's your interest rate.
Okay. And when you say pricing, when we're talking about a mortgage loan, are you specifically talking only about interest rate, or is there other fees that you mean when you talk about pricing?
Yeah, so pricing is your interest rate, but then there's always a cost to the interest rate. Okay. So this is where, as a consumer, you always want to pay attention to, it's called the loan estimate. So at the beginning, when you start with a lender and you start getting numbers from them, you'll get what's called a loan estimate. And that loan estimate outlines what you're borrowing, what your payment is, what your interest rate is. And then on the second page it's box A up in the upper left corner, it's going to tell you what you're paying for that rate. What's the lender charging you for an origination fee? What is your discount points that you're paying? Discount points are you paying money to buy your rate down to get a lower rate. So all of those fees will be up in that box A. So you'll be able to see, you know, from one lender to the next, who's charging me the most to get the interest rate that's on that first page.
I can just picture you visualizing this paper in front of you right now. It's box A right here, guys.
Yeah.
Look at it. That's great. It's how you know you've looked at a lot of them and you kind of like truly understand this information that we're talking about. So
Yes.
FHA loan and kind of talking through pricing, I think that's really helpful. I do want to dig a little bit into the USDA and the VA loans too, a little bit more. So let's just start with USDA. How is that different than FHA, and what are some of maybe the pros and cons of using a USDA loan to fund your mortgage?
Yeah, so USDA loan is a lot of first-time home buyers use that loan too because it has no down payment requirement. The USDA loan, it's pretty simple to figure out if a property is going to be eligible for that loan. Like I said before, it has to be outside of a big city, so you can't use that loan to buy within Rochester. But if there's a website that we go to, it's the USDA website where we can plug in a property's address and it'll say this property is eligible or it'll say this property is not eligible. So then it's pretty straightforward. You know if you can use that loan on that property.
Sure.
But yeah, that property's awesome because it's no money down, so it really breaks the barriers to entry with buying a home, you know, if people don't have a lot of money saved up for a home.
Yeah, so that's the one that kind of has that zero down payment option as part of it.
Yeah.
Is it recommended, like even if you don't, you should probably have some level of down payment if you're looking to get a mortgage. I think it's good to have a little bit of, you know, equity in the home out the gate. So is it often that people still can use that USDA loan if they have a down payment, even if it's small?
Yeah. Yeah, so the only really rule that USDA has is if they know that you have 20% to put down, because we have to collect bank statements whenever we're doing a loan for somebody. So if they see in your bank statements that you have enough assets to put 20% down, they're going to question, why are you using this loan? This is more of a loan for people that don't have those types of funds to put down. So then they'll actually disqualify somebody. But we do see people putting down money a lot of times, a little bit of money on the USDA loan. But a lot of people don't know is there's always two parts to a loan. So every loan out there is going to have some sort of a down payment requirement. Like USDA and VA, those are 0% down payment requirements, so you don't have to have anything. But FHA is 3.5%, conventional is 3%. So that's one part of what you have to have for funds saved. A lot of people forget you still have your closing costs. You have your property taxes, your homeowner's insurance, your loan closing costs, which include like title fees, appraisal, mortgage registration tax, all of that type of stuff. So, whatever your down payment is one thing, but you're still going to have, $5,000 to $10,000 in closing costs depending on the size of your loan. A lot of it's based on the size of your loan.
Okay. And then, so what about the VA loan? What is kind of unique and different about that particular type of mortgage program?
The VA loan by far is, if you can qualify for that loan, that's the best loan to take out because it has the lowest interest rate out of any loans out there. It has no mortgage insurance. So sometimes you've probably heard if you don't put 20% down, then you'll have mortgage insurance wrapped into your payment. But on the VA loan, there is no mortgage insurance, so you can do 0% down and you wouldn't have any mortgage insurance. So that makes your total overall payment that much less because you don't have that extra thing built into it. But yeah, as long as you've served in the military and you're honorably discharged and you have a certificate of eligibility, you can use that to go into your lender and qualify for a VA loan.
Wow, that's awesome. So it definitely sounds like there's a lot of avenues for people to get into homes from a mortgage product standpoint. That's not just the cut and dry 30-year fixed mortgage that everybody kind of thinks about out the gate. So I also want to talk a little bit about, because you brought it up at the start of our conversation, 30-year versus 15-year versus 10. Like, let's talk a little bit about choosing a term for your mortgage and what are the pros and cons to going longer or shorter with your mortgage term.
Yeah, I would say 90% of people choose a 30-year fixed term. That's the most common term out there because it's a longer term. So by stretching your payment out over 30 years, that keeps it as low as possible. And with house prices being higher and continually increasing year over year, people use that loan to keep their payments low. The downside is, for anybody that's taken out a 30-year fixed loan, you've probably seen on your mortgage statement, it doesn't move very much for the first 5 years.
It doesn't. It's so frustrating to look at.
You might have made $80,000 in mortgage payments, but your loan only paid down $10,000. So that's the frustrating part. There's a lot of interest built into that loan right up front. Versus if you can afford a 15-year fixed loan payment, I would 100% all of the time recommend a 15-year fixed loan over a 30-year fixed loan, because each time you make a payment on a 15-year fixed loan, you're going to see a larger dent into that principal balance right off the bat. It's not something you're going to have to wait 5 years to notice. And 15 years, if you can get rid of a $2,000 house payment in 15 years and not have a house payment after that, that sounds way better than having to wait 30 years.
Yeah. So and I'm assuming over the course of 30 years, you're really paying a significant more amount of interest over that 30 years versus a 15-year as well. Oh,
yeah. Yeah, you're probably looking at, double the amount of interest on a 30-year fixed loan over a 15-year fixed loan. And the other benefit on a 15-year fix is the rates are lower on a 15-year fix by about a half of a percentage point. So let's say you were at 6.5% on a 30-year fixed loan. A 15-year fix would be about 6%.
Yeah, which it sounds small when you talk about it as like 0.5%, but it makes a huge difference over the life of the loan.
Oh yeah.
And how much you're actually paying in interest. So so that actually brings me to another question that I wanted to talk to you. I don't think you've touched on it yet, but there are products out there called like balloon mortgages and adjustable rate mortgages. Can you talk a little bit about what those terms actually mean and kind of how those function a little bit?
Yeah, balloon mortgages and ARM mortgages, which are adjustable rate mortgage, that's what the acronym ARM is. They're very similar in the sense that they're set up to where your interest rate's only fixed for a set period of time. So the difference between them is a balloon mortgage says, okay, your interest rate's fixed for the first 5 years or 7 years, and then once that time period hits, you have to pay the loan off in its entirety. Most people don't pay the loan off in its entirety. They just refinance the loan at that point into maybe another balloon loan. Versus an ARM loan, same thing, your interest rate's fixed for the first set amount of time, like maybe it's 5 years or 7 years, but you're not forced to either pay it off or refinance it at that point. You just, at that point, whenever your interest rate hits that 5 or 7 year mark, whenever that first adjustment period is, then you're susceptible to whatever the market rates are. So if rates are higher at that time, then your rate is going to adjust and go up. If rates are lower at that time, your rate is going to adjust and go down. So the adjustable rate mortgage or the ARM mortgage, that can benefit you if rates are lower in the future, but it can also hurt you if they're higher in the future. And that's kind of what happened with the housing crisis in 2008 is a lot of companies were putting people into 1 year or 3 year ARMs, and then after that first year or after the first 3 years, their rate adjusted and went up 3 to 4 percentage points, and now that house that they could afford, they could no longer afford.
Yeah. So because to me, a balloon or an ARM is a terrifying thought that I wouldn't know, or I might have this huge payment that comes due. Like, when are these types of loans beneficial versus something like a 30-year fixed? I mean, I'm sure there's very specific scenarios where this is like the best way to move forward with your mortgage, and then there's other times where that 30-year conventional makes just more sense for the person.
Yeah, I would say the time that it makes sense, it's not often that I've put people into an ARM, and I've never put anybody into a balloon loan before, but the times that it does make sense are when you have somebody that knows they're only going to be in the house they're 100% certain they're only going to be in a house for a certain amount of time. Like maybe it's a house that they're going to live in and then flip, and they're going to buy it, fix it up, and then sell it in 2 years to avoid the taxation on it. So if you know that going in and you set somebody up on a 5-year ARM and their intention is to be out in like 2 years, then it's safe because you still have that 3 years left, if they did decide to stay a little bit longer.
Sure. No, that makes a lot of sense. It actually makes me think a little bit about, just because we live here in Rochester and Mayo Clinic, and we have a lot of residents that come in and they are going to be here for several years, but they maybe don't plan to live here long term, but they still want to have a home to be able to build up equity. Something like a balloon loan could make sense at that point, potentially.
Oh, yeah, for sure. A balloon loan or an ARM could definitely make sense for somebody that's going to be here in the short term like that. Yeah, as long as they know and have a pretty good idea that they're not going to have to be here after that. And another thing, too, is it's not like you're set in that loan forever. You can take that loan out and then refinance it into a 30-year fixed 2 years later if your life changes and all of a sudden you get a job offer and they say, we want to keep you here and keep you on staff. So it's just something where we'd refinance the loan at that point.
Yeah. Well, we are out of time. It went by
That's
really
quick.
fast. And I feel like there's so much more ground we could cover with all this. I have a million more questions, but we do have to wrap it up. So Nick, thank you so much for being here.
Thank you.
You shared a ton of great information, and thank you for joining us as well. This has been Good Money Moves. Make sure you like and subscribe. And if you want to learn more about all of your different types of mortgage options, you can visit our website at firstalliancecu.com. And until next time, stay financially empowered.